Hey everyone, welcome back to Corporate Decoder, where we decode the confusing language of corporate filings and figure out what's really going on behind the scenes. Today we're diving into Blackstone Private Credit Fund's latest report, and let's just say, if you're interested in how money moves, you're going to want to pay attention because this is a masterclass in private lending. Are you ready to unpack a quarter of strong returns and strategic maneuvering in the private credit market? Well, buckle up because we're about to break it all down. And hey, if you dig getting clear, no-nonsense insights into these complex financial documents, make sure you're subscribed to the channel. Also, we have a fantastic community over on Discord where we discuss these reports in real time. The link is in the description below, so come hang out with us. Alright, let's jump right in with the core of this report, which is giving us a picture of how Blackstone Private Credit Fund, or BSHRED, performed as of August 1, 2025. Now, the first thing that jumps out is the positive sentiment about the market. They're saying that over the last 3 months, things got a lot better. Worries about trade disputes, rising prices, and the overall health of the economy have eased up. This created a good environment for BZED, and they delivered a solid 2.3% return just in this last quarter alone. That brings their total return for the year so far to 4.3% return just in this last quarter alone. That brings their total return for the year so far to 4.3%. What's really interesting here is that this performance actually beat other types of investments like leveraged loans, high-yield bonds, and bonds considered safe, or investment-grade bonds. But it's not just about market feeling good. They've been busy investing. This quarter, BSRED put over $4 billion to work, meaning they lent money out to companies. They're being selective though, focusing on quality. One example they highlight is lending $1.5 billion to a company called Baker Tilly, a big player in accounting and advisory services. This loan helped Baker Tilly merge with another company, making it the 6th largest accounting firm in the US. They also put $500 million VELIN into a healthcare technology company called Acuity Delivery Systems, and they did this with a low risk level, meaning they didn't lend more than 35% of the company's value. The average interest rate on these private debt deals was a healthy 9.3%. In fact, 91% of their new investments were the safest kind of loan. The first lien debt, again with a low loan to value, meaning they're not lending more than 34% of the company's value. The average interest rate on these private debt deals was a healthy 9.3%. In fact, 91% of their new investments were the safest kind of loan, the first lien debt, again with a low loan to value, meaning they're also using insights from a team called BXC's Portfolio Insights team. This team looks at over 5,000 companies to spot trends early. BSED is focusing on bigger, high-quality businesses in what they call good investment neighborhoods. The average company they lend to has $251 million in earnings before interest, taxes, depreciation, and amortization over the last 12 months. That's about 2.5 times bigger than the average company in the private credit market. This means they're lending to more established, larger companies. Even more reassuring, 92% of BC's investments are in private companies, not those traded on public stock exchanges. And almost all of their loans, 97%, are senior secured debt, which means if something goes wrong, they are at the front of the line to get their money back. Their average loan to value across the whole portfolio is 43%. They also spread their investments out widely with over 600 different companies across more than 50 industries. This means no single company's problems will sink the whole fund. The average size of their private debt investments is pretty small, about 0.30%. They also spread their investments out widely with over 600 different companies across more than 50 industries. This means no single company's problems will sink the whole fund. The average size of their private debt investments is pretty small, about 0.0% of the total private debt portfolio, which again speaks to their diversification. Now, BXC has a program to actively help the companies they lend to improve. They call it the Value Creation Program. For example, they helped a healthcare company cut costs by 13% by managing their spending better and using a special online platform. This program also helps them get real-time information from these companies. This data helps them avoid risks and also boost growth. The earnings of BSAG's portfolio companies have grown by 10%, which is twice the average for companies in the private credit market. And here's a really important metric, their non-accrual rate, which means loans that aren't paying interest or principal, is only 0.4% at their cost. This is way lower than other similar companies. This suggests their loans are performing well and companies are paying back what they owe. Another big plus is that BSTEED operates with the lowest borrowing costs and operating expenses compared to other non-publicly traded companies like them. This efficiency helps boost their earnings and overall returns. They are also rated highly by Moody's and S&P, which are major credit rating agencies. This means they are considered a solid, reliable investment. Looking ahead, they believe private credit will continue to be a strong investment. During recent market ups and downs, BC did well, while other investments like leveraged loans took a hit. Private credit proved its worth by continuing to provide stable financing for businesses, even as other lending markets slowed down. Their pipeline, meaning the potential new deals they are looking at, is growing fast. They screened almost 50% more new private deals this quarter compared to the previous one. They have over $10 billion ready to invest and are using leverage, meaning borrowed money at a ratio of 0.68 times. This means they are using borrowed money to amplify returns, but they are doing it at a controlled level. And they have paid out distributions to investors that are even higher than what you'd get from leveraged loans. They are focused on keeping the value of their assets stable and using their strengths to create long-term value for those who invest in them. Tab dig now, let's get into some of the specific numbers from their tables. First up, we have BC's summary statistics. The earnings yield for their Class I shares is 9.6%, and the annualized distribution rate for these same shares is 10.5%. This means that for every dollar you invest, you can expect to earn about 9.6 cents in earnings and receive about 10.5 cents in distributions over a year before any fees or taxes. Looking at their assets, we see that 97% of their investments are in senior secured debt, which we discussed earlier as being the safest type of loan. That's a strong indicator of low risk. Also, 97% of their investments are floating rate, meaning the interest paid on these loans will go up or down with general interest rates, which can be beneficial in a rising rate environment. And here it is again, the non-accruals at cost are just 0.4%. This is super low and shows they are good at picking loans that actually get paid back. On the liability side, their debt to equity ratio is 0.68x. This means for every dollar of equity, they have about 68 cents of debt. This is a pretty conservative leverage level. For liquidity, they have over $10 billion in cash and amounts they can borrow. This is a massive war chest for new investments. Now let's look at the BXI value creation program. They've achieved $5 billion in illustrative value creation overall. Specifically, they've helped companies reduce costs by $441 million, and they've helped companies boost revenue by $272 million. These are significant numbers and really show the value they add beyond just providing capital. Diving deeper into their new investments in the second quarter of 2025, we see that 91% were first lien debt, and the average loan to value was a very responsible 34%. The average yield on these new loans was 9.3%, which is a very attractive return. And looking at their North America direct lending strategy, their loss rate has been a minuscule 0.05%. This is incredibly low and speaks volumes about their underwriting and risk management. And they are the sole or lead lender in about 80% of these deals, which means they have a lot of control and direct involvement in these investments. It's important to remember all this data is as of June 30, 2025, so it's a snapshot in time. And as they always say, past performance doesn't guarantee future results. They also define their peers here, which includes both publicly traded business development companies or BDCs and those that aren't traded on public exchanges. This helps us understand how they stack up against similar companies in the industry. Now, they do mention leverage. They intend to borrow money to boost returns. While this can amplify gains, they rightly caution that it also amplifies losses. If investments don't perform well, the losses can be much bigger because of the borrowed money. This uses financial risk and makes them more sensitive to things like rising interest rates or economic downturns. So while leverage can be a good thing, it's a double-edged sword. You have to be careful with it. And finally, they have a whole section on disclosures, which basically means they're telling you this information is being provided and not officially filed yet in a way that incurs certain legal liabilities. But it's still important to read. They also clarify that this report isn't an effort to sell or buy any securities. So what's my take on all of this? B Street seems to be doing a really solid job in a challenging market. They focus on larger, high-quality companies combined with their disciplined lending approach, and a very low rate of problem loans is impressive. The fact that they add value to their portfolio companies beyond just lending is a real competitive advantage, and it likely contributes to their strong performance. Their diversification across many companies and industries is a huge strength, reducing the impact of any single bad investment. The low operating costs and borrowing expenses also mean more of the returns go back to the investors. The main risk, as they themselves highlight, is the use of leverage. While currently at a conservative level, any significant economic downturn could amplify losses. Also, the private credit market relies on access to capital, and if that access were to dry up, it could impact their ability to deploy capital and generate returns. However, based on this report, BSA, it appears to be a well-managed fund that is effectively navigating the private credit landscape. They are delivering strong risk-adjusted returns and demonstrating a clear strategy for growth and value creation. Alright, that's our breakdown of Blackstone Private Credit Fund's latest filing. What do you think about their strategy and performance? Let me know in the comments below. If you found this analysis helpful, please give it a thumbs up and subscribe for more corporate deep dives. And don't forget to join our Discord community for more discussions like this. Thanks for watching, and I'll see you in the next one.